Ladies and gentlemen, it is my pleasure to welcome you all back for our quarterly investment and market update as we review the last quarter. We are here thanks to Virtual Financial Advice. My name is Paul Jant and I'll be your host today, so thanks again for joining us. Now, firstly, let me welcome you to Virtual Financial CEO. I've got Adem Becirevic. I've got Shartru Wealth CEO, Rob Coyte. Welcome back for our quarterly investment and update. Lads, how are we?
Excellent, mate. Thanks, buddy.
That's good.
G'day,
Rob,
Paul. Thanks for having me.
Brilliant. Now, we've got a special guest today. We've got Hugh McNally, CEO and founder of Private Portfolio Managers as well, better known as PPM. Hugh, welcome to our quarterly investment and market update.
Thanks, Paul.
Great to have you guys here. Now, Adam, what I might do is, mate, I'll throw to you, maybe to share a little bit about your relationship with Shartru Wealth, as well as how Virtual Financial work with PPM. I think it's really important that we sort of frame that up and also share that this is general advice only.
Yes, Paul. So at Virtual Financial, obviously, we've got certain investments we use for our clients, and we have the MDA, which is very popular with our clients. But we also use private portfolio managers in our retail fund with Hub24, which has been very, very successful. Our clients love the idea of having direct shares where, you know, it's transparent, they can see through it and they can really see how it's performing. Private portfolio managers have had great returns, which has been fantastic. Just so has the MDA. So, you know, both of our investment portfolios are doing very well, and it's great to have Hugh here today. So thank you for joining us, Hugh.
Thank you very much for having us.
Brilliant. Let's get into it, guys. Adam and Rob, I'm going to talk to you guys in particular first of all, and then we'll come to Hugh and PPM shortly. Let's talk about market updates. I suppose inflation slightly down, interest rates. Interesting, I saw the ANZ CEO on TV last night talking about interest rates. They're tipped to go down, but he's also saying, let's not get too excited about that. A lot of spending taking place prior to Christmas. Rob, what are you seeing?
Yeah, well, I guess on the inflation front, inflation has come back down towards their range of 2%, which is a figure I think they just pulled out of nowhere. But for what it's worth, it's getting closer to that. But in saying that, it's still above it, and it's appearing to be quite sticky. In saying that, it doesn't change the fact that over the last few years, the inflation that we've had has meant that prices have gone up 20 to 30%. So if people's wages haven't gone up with it, they still feel the pinch of being behind. So, you know, as much as economists like to talk about inflation, that's the real life effect of what inflation is. On the interest rate sort of question, as I've sort of been saying for years, I think interest rates are actually going up, not down. And they're going up purely because of demand and supply. There's large amounts of government debt around the world. There's less people, and when I say people, I'm talking about people like China, definitely not Russia. Japan now, they're not lining up to buy US debt the way that they were previously. And even if we just look at the bond markets, you know, over the last little bit, a month ago, the 10-year US was around about 3.664, I think it was. I think it's as low as it got. In less than a month, it's now back up to 4.19%. Okay, so that's the market telling you that they don't think interest rates are going down. They think that inflation's going to be around, and they think that, well, they want higher rates to compensate them for the risk that they're taking. So, yeah, central banks, they can determine the front end of the curve, but the back end of the curve's determined by market participants, and that's really the part of the curve that we're interested in.
Yeah, well said. Adam, anything you'd like to add to that, mate?
Yeah, look, inflation from our clients' point of view is very interesting. Our clients have, you know, I was talking to a client yesterday, and it's very interesting. You know, he was saying, you know, his school fees for his kids are going up every year, you know, without fail. Everything's going up. He said in the job he's in, you know, it was, you know, he's an accountant, actually earns quite good money, but he's an employee. But he said in 6 years, he hasn't had a pay rise. So even though he was on good money, that kind of every year with inflation going up and up and up, he says it's really biting in. And then like his interest rates have come out from 2%, and now he's paying 6.7%. And then obviously on his investment property as well. So he's really, probably still capital rich, but from a cash flow point of view, week to week, he says, like we don't have a lot left over at all. And that's from someone that's on $200,000 a year, so who's struggling week to week. I mean, obviously he's paying for private school fees, but, I think the middle class, are really struggling, to meet expenses these days with everything going up. So if your pay's not going up, 10% a year, you're falling behind probably.
And that's probably the interesting chat, I suppose, amongst the, Rob, you have spoken about interest rates probably going up, where all the other talk is about it coming down, and that squeeze, especially a lot of people in the next probably 12 weeks going to be relying a fair bit on credit cards, and they'll see the effects of that probably come February 2025.
Yeah.
Yeah, well, it just on the interest rate thing, there is a thought in aspects in parts of the market that the US has actually got itself in a position of fiscal dominance, which basically means it can't service its debt.
Yep.
So when you look at all the fiscal position of the US, they can cut defense spending. That ain't going to happen. There's wars on two different fronts at the moment.
Yeah.
They can cut Social Security or Medicare entitlements. Politicians aren't going to do that. The only real variable is the interest rate on the debt. And if they reduce interest rates, that gives them a little bit more breathing space. So whether that's the motivation, I don't know. The market will decide these things. But it's definitely an argument, and it's definitely something that's got a lot of credibility and needs to be considered.
Yeah, very true. I suppose last update, we spoke about the UK and the French elections. We've now got, I don't know how many days away is from the US election. What is it? 12 days, 13 days. I'm not quite sure exactly what it is.
Too many.
Yeah, that's right. But it's good. It's going to be over soon. Then we'll have the aftermath to deal with. Have you seen any changes when it comes to the international markets having an effect on our markets?
Yeah, look, I think, and probably Hugh's better positioned to say this. I think, Trump's very much seen as positive for the markets, equity markets in particular, in saying that he is really firmed into favoritism over the last couple of weeks. He's definitely, look from the analysis that I've seen, looks like he's getting close to a lock on getting the win. In saying that, he's also talking about tariffs and other things which will have negative consequences. But the elephant in the room, regardless of if the Democrats or the Republicans get in, and regardless of the composition of how they get in, i.e. whether they control both houses and the presidency and what have you, the elephant in the room is still the debt and the fiscal position, and no one's talking about it. So from that perspective, my thesis is that's driving a lot of these things. It's actually putting them in a position where central banks don't actually have a choice, but no one's dealing with that issue. So my view is it doesn't really matter who gets in. That problem's not going to get fixed, and it's going to be business as usual.
Okay, interesting. Let's talk about risk for a sec. So I know you're always talking about, managed risk, risk away from markets with uncorrelated investments. Are you okay to go into a little bit of detail around how that works?
Yeah, sure. So, basically, I guess the simple way to put it is don't have all your eggs in one basket. And people understand that if they've got a share portfolio, they can be diversified. So you might have 10 different stocks, you're diversified. The problem is that those 10 different stocks are what we call highly correlated. They will tend to move together. So they'll either go up or down together. So from an investment perspective, what we want to do is we actually want to own assets that are uncorrelated. That gives us, a lower level of risk. So what we're seeing at the moment, and this is an international phenomenon, people are holding as a percentage more equities as part of their wealth than they ever have in the past. which is fine when equity markets are going up. However, equity markets do go the other way as well. And from that perspective, as an asset allocator, our job is to make sure that, equities are a very important part of that piece, but they're not the only piece. And I think it's also important to point out that, any asset class, not just picking on equities, it can be property, it can be anything, has its time in the sun. And there's a thing called reversion to the mean. The way I like to explain it is the better the party, the bigger the hangover. If we have really good times in markets, that's got to be followed by more somber times. That's how it works. And there's periods of time throughout history where markets haven't performed. They haven't kept up nominally, and they definitely haven't kept up with inflation. And that gets back to, one of the most important aspects of that is actually valuation, which is where guys like Hugh, they're only buying stocks that are reasonably valued, and they're not paying too much for assets, because that's an important part of how you protect your position. But from our perspective, we like to have sort of, depending on the risk client, 30 to 40% of assets in equities, and then we like to have the remainder in other asset classes, which will perform differently.
Yeah, okay, to share a little bit about what those classes would be?
Yeah, it might be things like direct property.
Okay.
So owning direct property, direct infrastructure. They're more, they're just, they're very simple assets. Importantly, those sorts of assets, the income is actually indexed to inflation. It's actually written in. So rent goes up, when you're on the toll road, your toll goes up every 6 months. As you drive along, they very kindly tell you that from the 1st of January, it's going up. And they always seem to, they don't miss too many.
No.
So they're the sorts of things, that we've got. We, obviously we've had a large holding in gold, which has actually performed very well as well. But there's a whole range of assets out there that we can get exposure to. And then there's your usual suspects in fixed interest, where we're actually lending people money, and how we go about doing that. So that's just a little bit of a taste of the different sorts of things that you can have. And from a risk management perspective, it's very important to make sure that you don't have assets that are highly correlated, because what that means is the good times are good, but the bad times are terrible. And the human nature of investing is, when people are making money, they don't seem to care. It's all good, whatever. But when they start incurring some losses, they really feel the pain of a loss. So that's the risk-averse nature of people.
Yep. So managing that and having that managed risk, I suppose that's what I know I've heard Adam and you talk about quite a lot in terms of that managed risk portfolio.
Yep.
Yeah, brilliant. Adam, when it comes to your clients, I know you mentioned, you gave us a good story just before. What are you hearing in terms of their concerns? Are they happy to play the long game? I know Rob often talks about the long game. We can always look at the way the markets are today and tomorrow, but it's about the long term of their investments. What are you hearing?
Yeah, look, we obviously have every client has a different risk profile. Some are a bit more aggressive than others. Some don't want to lose money. So depending on where they sit on the risk profiles, depending on how we invest their funds, a lot of our clients obviously are in the MDA. We set up through Rob and his investment committee, and as he said, non-correlated assets and risk-adjusted returns, and they feel very comfortable. Like, we don't have any issues with clients kind of worrying about their funds. I had a couple of reviews yesterday, and in the MDA, where we've kind of designed our own MDA here at Virtual Financial, using obviously all the investment choices from the Shartru menu, and the returns last year were 12%. So the clients have got a risk-adjusted portfolio, uncorrelated assets, and a really good return. And then obviously our clients that use the retail platform and PPM have also have got a very good investment portfolio, because obviously Hugh will talk about the way that they look after risk, but I just love the way that when they're investing in companies, they invest, they're buying valued companies that aren't overvalued. They're buying companies with no debt, billions in the bank, and that return dividends to clients every year. So most of our clients, we have very little pullback from clients ringing us up, kind of complaining about the markets, worried about the markets, because as Rob says and you said, it's a long-term game, and long-term, both portfolios have done very, very well in the long term.
Brilliant, brilliant. Another one with 12%.
No.
Let's bring in PPM CEO Hugh. Welcome, mate. Welcome again. Are you okay to share a little bit about your success over the past 30 years? I know Adam's shared a little bit about how Virtual Financial works with private portfolio managers. Be great to hear a little bit about what you guys have, your shared success over the last 30 years.
Yeah, thank you very much, Paul. I guess we started in 1995, and the objective really was to generate an attractive return, which we set at somewhere between 8 and 12% over a 10-year rolling period. And that, I think, is the sweet spot for us, that we're not taking too much risk and we're not being too aggressive, particularly at times when valuations are high. And I think that if you look at the history of markets over very long periods of time, the periods when you get the lowest return are when you have paid the highest prices, and that's the examples might be sort of in the US market at the beginning of the 21st century. So we went for nearly 12 or 13 years before we made a new high after the bubble in the tech sector. So I think that's a key message, that the two biggest risks are overgearing and paying excessive prices. And if you avoid those two, you'll end up with a return that is pretty attractive over the long term. You might not get the sort of 30 or 40% returns that some managers achieved at the ends of booms when the markets go parabolic. But you don't suffer the hangover of a very good party. And I think it's very hard to leave the party when it's rocking and rolling. But that's something you've got to steel yourself against. And great companies will survive the downturns, and the returns will be attractive as long as you don't go over the top. And that's been our basic strategy over the last sort of 3 or 4 booms.
Yeah, brilliant. Mate, are you okay to talk about one of a more recent stock in your global portfolio, a stock by the name of Alta, and why you actually bought them?
Yeah, so Alta is it's a retail company. It's the largest retailer of beauty products in the US, and half of the population would regard these as non-discretionary items. Particularly girls in the sort of the age group of perhaps 15 to 60. So it's a very it's a sector of the retail market that is actually not as non-discretionary as one might think. The model's basically been somewhat similar to other rollouts of large chains, such as Walmart or any of the home goods chains. So they started off as about 20 or 25 years ago as a small retailer, and just built out the series of chains, focused entirely on beauty products, and they gained the benefits of scale and specialization. Very high returns on capital, very well managed. It's probably growing at more of the order of 5% per annum now, but the key item, the key element is the return on capital, and that's been very high, and they've been able to return large amounts of capital to shareholders. They have a few, 3 or 4 competitors, and then a long tail of retailers of beauty products in department stores and other things, which they're gaining market share over time. So we think it's a long-term growth story with moderate. Well, the growth may have moderated over the years. The pricing is pretty attractive, and it's very strong financially. We think it's quite a good situation.
Yeah, brilliant. I saw a note that Warren Buffett actually bought them after PPM did. Is that correct?
Well, it's hard to tell.
Either way, it was a good decision.
Yeah, we hope. Yeah.
Let's jump into a couple of other things as well. I saw Warren recently a couple of months ago when we were all together down in Queenstown or across at Queenstown, and he spoke about companies like James Harvey Norman, JB Hi-Fi, household names, let's call it.
Yeah.
Why have you guys chosen to go into those particular household names?
Well, I suppose the key thing driving our investment strategy is return on capital.
Okay.
In the long term, the investor makes whatever the company makes, and it's that return on capital that is absolutely critical to the long-term success of an investment. And each of those companies that you've mentioned, the returns on capital are very attractive. And we're not having to pay excessive prices for those companies.
Okay.
So that's basically and the structure of the industry that they're in is such that they can maintain those returns on capital, which is a critical factor also. I mean, you look at there are industries where the competition is irrational and nobody makes any money. Perhaps the obvious one in Australia is telcos. Here's an industry where there's an insatiable demand for their product. The amount of data across their networks is expanding at an enormous rate. Yet revenues are flat. The return on capital for Telstra is barely their cost of capital, and for the other two, their returns are well below. Irrational competition, but
yeah.
So we're trying to find industries where the competition is rational. There's a dominant player that can derive a premium in their returns.
Brilliant. Thanks, Hugh. Now, I suppose, Adam, back to you for a second.
Yep.
Why is that? And I suppose we just heard Hugh talk about that return on capital and the importance of that. Why is that important to you and the clients at Virtual Financial?
Oh, I suppose our clients are looking for, returns, obviously, and they're kind of hoping to get somewhere around that 8 to 10%. And how Hugh and PPM are the companies they're looking at are paying those good, 8 to 10% dividends back to the clients. So even without any capital growth, they're getting roughly around that 8%. So and hopefully if we get some cream on top and we get some capital growth as well, then the clients are kind of right where they want to be. So it's clients are very very comfortable investing with PPM because of that factor, and because it's transparent. There's no debt there. There's not a lot of risk. Like you can't see JB Hi-Fi or Harvey Norman or Westpac Bank going broke tomorrow. So they feel very comfortable. That's why when markets do go up and down, and they do go down, we generally don't get any calls from our clients because they understand we're playing the long game, and we're in companies that are very, very safe. They're paying good dividends, and it just ticks along.
Yeah, brilliant. Well said, mate. Well, gentlemen, thank you. This is probably, I'll allow each of you to obviously have any final comments if you wish to share anything before we look to wrap up. Hugh, I'll go to you first of all. And again, a big thank you for joining us today as a part of our quarterly investment and market update. Any final comments from you?
Yeah, I think the comment that Rob Coyte made about long-term interest rates is a good one. I mean, it's said that since the beginning of this year, long-term rates have actually gone up, both in the US and here, and they are actually, in a historical sense, low. So we would not be terribly surprised if, while short-term rates came down, long-term rates edged up, and that has implications for valuations, I think, and that's probably the thing that's most sort of concerning us about, I would say.
Okay. Rob, any final comments from you, mate?
Yeah, no, I'd agree with what you just said regarding valuations. I think at the moment it's staring everyone in the face that nothing's cheap. And as Hugh rightfully pointed out, generally periods of poor performance, if you will, when you talk about returns, is because you've bought things that were overvalued. So the trick is avoid buying stuff that's overvalued, I suppose.
Good advice. Good advice. And Adam, final comments from you, mate, before we wrap up?
Yeah, I'd just like to thank Rob and Hugh. Thank you very much. I mean, obviously for our clients who are listening, you're in good, safe hands with these guys. They definitely know their stuff, as you can see. Our portfolios, depending on which way you want to go, are both very, very good portfolios. So, yeah, and thank you, Paul, for hosting.
Yeah, well said, mate. Well said. And to Rob and Hugh, thanks again. Adam, thanks again to all of you that have joined us today. Thank you. Thanks for being a part of our quarterly investment and market update brought to you by Virtual Financial Advice. Signing off till we see you next time. Thanks, guys.